Continuing with objective 3, equity participations. What do we mean by equity participations? The Lebanese chart of accounts put conditions on purchasing equity participations other than the purchase of blocked and placement securities. So we have to differentiate between when we buy equity participations and other companies and the blocked and the placement securities for trade for long or short term. The equity participations are evaluated by the present value and the date the purchase happened. So whenever we participate in other companies' shares, we have to evaluate based on the date of purchase, even if securities are priced in a stock exchange or not. The present value is defined as the price paid by a rational businessman to invest in such securities. The value is defined by the benefits of the security to the company. When I participate in other companies' shares, different factors actually are affected for the price. The dividends of the securities or the value from these securities. So whenever I have shares in other companies, the dividends are actually affects my purchase price for these shares. The net value of the owner's equity of this company also affect the price. The availability of these securities to be transferred into money quickly, liquidation actually availability, also the economic situation of the country the company operates in, the stock exchange price, and the purpose to buy these securities. So many factors plays a role in evaluating the purchase price of equity participations. Let's see this practical real life example. On 1/1/2021, XYZ company purchased securities from other company called Barbara Company, representing 30% of Barbara's capital, which is 3,000 securities for an amount of $4,200,000. The expenses of the operation was $53,770 paid via bank. On 1/7/2023, the company XYZ increased its partnership in Barbara by purchasing additional 1,000 securities for $1,600,000, and the expense was $19,200 via PQL Bank. On 31/12/2023, the value of securities according to benefits was $1,430 each. However, the price in the stock market was $1,500. Another information for the year following 2024, the actual value was $1,400. However, for the following also year 2025, the actual value was $1,440. I have to record the necessary journal entries for the purchase operation on 1/1/2021 and on 1/7/2023, and to journalize all necessary transactions on years 2023, 2024, and 2025. Starting by the purchase operation on 1/1/2021 and then on 1/7/2023, the entry is to record the purchase of 3,000 securities at a cost price $1,400 given equal $4,200,000. So I debit account 251 equity participations in financial fixed assets account class 25 $4,200,000. I debit 62692, which are expenses accounts in financial charges, $53,770, and I credit bank account in 512 class $4,253,770. The second entry is to record the second purchase operation happened in the 1st of July 2023 for additional 1,000 securities at a cost of $1,600, amounting for $1,600,000. I debit 251 same account equity participations. I debit 62692 financial charges accounts, and I credit banks accounts in account 512. The second year 2023, I have to record actually the to manage provisions I have to compare between, as we said, the inventory value and the purchase price. But because I bought different securities, the first 3,000 at a different price, the second 1,000, as you can see, I have to calculate an average price for the total securities, which are now 4,000 securities. So I add the total amount of the first 3,000 plus the second amount for the second 1,000 over the total amount, which is 3,000 plus 1,000 securities. So I got a weighted average cost of $1,450. Now I need to compare between the 1,450, the purchase price, and the inventory actual value, which is given at the end of year 2023 at $1,430. So comparing between the purchase price and the inventory value, I have a decrease of $20 per security. So total securities are 4,000 times $20. I have a decrease of $80,000. What is the accounting entry for this decrease? I need to record a provision by $80,000. So I debit 679 account amortization and provision of financial charges, and I credit 2951 account provision for diminishing in value of equity participations. In the following year, I do the same exercise for year 2024. I need to compare between purchase price as an average cost or average price and the inventory value or market value. The average cost is still the same, $1,450, but the inventory value or actual value is set at 1,400. So I have a decrease of $50 per security times 4,000 equal $200,000. So I need at the end of year 2024 a provision balance of $200,000. But the previous year provision balance was set at 80,000, so I need to increase provision by $120,000. So I do the same entry. I debit 679 account amortization and the provision of financial charges, and I credit 2951 provision for diminishing value of equity participation by $120,000. Moving to the last year, which is year 2025, also I do the same exercise. I compare between the actual between the inventory value and the purchase price. I have a weighted average still the same, 1,450, and I have an actual value which is $1,440. So I have a decrease of $10 per security times 4,000 securities equal $40,000 decrease. So I need a balance of provision at the end of year 2025, $40,000. I compare with the previous year, which was $200,000. So I need to decrease now provision by $160,000. What is the accounting entry? I debit 2951 account provision for diminution value of equity participations, and I credit account 779, which is related to financial provision, right back by $160,000.